Welcome to the August 2022 monthly market update. My name is Ryan Flanders, and I am the Flanders Group's Chief Investment Officer. It's not a shock to anyone that the first half of 2022 was simply wretched, though July saw a very solid rebound in the financial markets with the strongest monthly gains seen since 2020. In fact, most of June's sell-off occurred during only a 3-day stretch, and otherwise, we have had a relatively stable start to the summer. The U.S. and other developed international markets were all up by at least 5%, with only emerging markets lagging. And not to be left behind, fixed income had a strong month as well. And yet again, the primary driver of the rebound was the Federal Reserve. Although inflation remains high, the Fed has now raised rates close to the perceived neutral level. The neutral level is simply the zone where the economy is not intended to meaningfully grow or to shrink. And markets are starting to anticipate that the worst of that tightening cycle is behind us, which has brought the longer-term interest rates down some. There's been lots of talk about the yield curve inverting, but this inversion has been purposefully induced and should be analyzed in a different light than we are historically accustomed to doing. Lower long-term rates provide for higher stock market values, and the decline in the 10-year yield was notably impactful, driving investors to begin to dip their toes back into the water after the pullback had created a considerable market discount. But although July was a pretty good month, most equity markets are still down double digits from their peak at the end of 2021. So have we found a bottom, or is this a shorter-term rally still in the middle of a longer downtrend? Well, the center issue to this conundrum is our economy. Are we in a recession or are we not? With our economy contracting now for the second quarter in a row, we've now met what many consider the definition of a recession. But despite the headline GDP reading, the actual data isn't all that bad. Both quarters' readings come from more technical factors related to ongoing pandemic-era supply chain problems and some shift in consumer preferences, rather than from our real economy. Remember, GDP readings are looking in the rear view. That quarter's already passed, and rather than looking behind us, let's focus on the road ahead. So where is the real economy going from here? So far, the data remains pretty healthy. Companies are still hiring, and business investment remains healthy. The biggest risk here is from consumer confidence, which is understandably down, driven by higher inflation and gas prices. And if lower confidence leads to less spending, it will cause a drag on our economy. So it is definitely a real concern. But here too, the risks appear to be stabilizing. Inflation appears to be peaking, and gas prices are well down from the start of the summer. And while concerns remain, confidence and spending appear to be plateauing, while the other factors all appear to be healthy. So all in all, July saw the risk levels for the economy moderate, and that's definitely good news. Equity valuations are now at more appropriate levels, and as a result, we have less potential market risk. With companies reporting higher than expected profits for the second quarter and now forecasting an improvement in the third quarter, earning risks are becoming less of a factor and should continue to get better as the economy improves. So despite the ongoing headline scares, last month's rebound illustrates why we constantly reiterate that the markets are forward-looking machines, and the worst may very well be behind us. Historically, returns following a bear market have often been positive, and significantly so. In July may mark the first step in that direction. Now, that's certainly not to say we're out of the woods yet. Inflation may continue to trend upwards, COVID will probably surge yet again in the fall, and the war in Ukraine could possibly expand. And if any of those events, or ones that we haven't even anticipated yet, happen, we will see more market volatility. But despite the rear-facing headlines, most of the risks continue to moderate, and that's what's most important when we look forward. With potential further rate increases, gas prices possibly climbing again, and the midterm elections this fall, we'll no doubt see more economic and market gyrations in the coming months. But July's rebound shows we may well be through the worst of it. The risks are real, but the markets respond to the fundamentals. Right now, the fundamentals remain healthy. That's it for this update. Thanks for watching. Join me again in September for the next one. And as always, please feel free to reach out to our office with any thoughts or questions that you may have along the way. Thank you.